Hello everybody, good afternoon or good morning, depending on where you are in the world. My name is Luke James. I look after commodities, markets and climate change at Reuters Professional. I'm here from London today and delighted to have a fantastic panel before you. We're going to be looking at freight and shipping, driving markets forward and looking at the technologies behind that and how they can help mitigate risk and identify opportunities. So we've got a great group. We've got Peter Sand. There we go. I've gone into gallery view there before we actually do the waves. Peter Sand from BIMCO. So Peter is the chief shipping analyst. So BIMCO, for those of you who don't know, is one of the largest direct membership organisations for ship owners, charterers, brokers and agents who work very closely in promoting and securing global standards across the maritime sector. I've got Arthur Richier, who's the chief freight analyst with Vortexa. Now, Vortexa are an oil and gas analytics platform that provide critical business intelligence into waterborne movements across the world. And last but not least, welcome to Mikkel Seidelin, who is the director of chartering and freight trading with Teekay Tankers, the largest operator of mid-sized tankers. So welcome to the group. Now, before we kick into the conversation in detail, a few bits to you, the audience. We'll be having some conversations across four central themes. We're going to look at market outlook, we're going to look at the impact of new technology, how analytics is then shaping these opportunities and looking at various risk markets and where we're heading. And finally, we're going to look at overall world energy demand. Now, as we go through, this is, I should say as well, at the start of IP week, there's probably less time in pubs this week and more time on online calls like this one. We want to interact. We want to hear from you, put your questions to us, and we will look to put those to the group and respond in due course. So please raise your hand and put the questions on the platform. We will use them as we go through. So shipping really is the lifeblood of the global economy, responsible for the carriage of more than 80% of world trade. It's $1 trillion industry, and it's been hit by a pandemic, which we're still moving through. I'm sure many of you are still watching this from home, not the office. We're looking at different sanctions, trade demand, and also a very pressing climate agenda. So I want to kick off really with that first theme, market outlook. And Arthur, in fact, I will start with you. And if you be so kind, I'd like to ask you to introduce yourself further, your background, your role, and then your perspective on the global freight market and a key challenge you think we need to overcome. So Arthur, welcome.
Thank you for the intro, Luke. And it's really a pleasure to be here with Peter and Mikkel. So my name is Arthur and I'm the senior freight analyst at Vortexa. I started my career as a consultant to the shipping industry in Singapore, actually looking at containers before moving back to London to join the tanker pricing desk at S&P Global Platts. Then last year, I joined Vortexa to help develop our freight analytics offering. Now, when I'm not helping develop our current and future freight offering, I use our data sets to provide insight to our clients, as well as to the market as a whole. So looking really at freight markets and tanker markets in particular. And so as Luke said, it's the latter we're going to focus on first. I'm going to try to beat the COVID drum as few times as I can during this webinar, but I can't promise anything. So if we start by looking at pricing and freight rates in general, some would say they're in the gutter. Arguably, they're in the doldrums. If we look at VLCCs, for example, what I've done is I've averaged the main VLCC trading routes. So loading from the Middle East, West Africa, Europe, and the Americas, all heading to Asia. Looking at that average over the last couple of years, we arrive at about $18 per metric ton. So let's use that as a benchmark for now. To put that in a bit of context, we're currently at about $12 per metric ton, while last year the average for 2020 was 22, and for 2019 was 23. But I'm going to argue that these were not really the norm. At the end of 2019, specifically September, October, saw successive tanker attacks in the Middle East, as well as the sanctioning of a significant portion of the tanker fleet, Chinese tonnage to be precise. So that led to an increase in rates because on one hand, we had higher insurance costs, and on the other, the vessel supply was reduced. Now, 2020 needs no introduction, but as a reminder, tanker demand reached record highs with an oil market in contango following a price war between Saudi Arabia and Russia. So if we run this analysis again, by removing the whole period from September 2019 to May 2020, we're actually comparing today's numbers against a more reasonable average of respectively $14 and $16 per metric ton versus 12. Now, the point I'm trying to make here is that we've had periods of spectacular earnings, and the fall each time has been harder, but we weren't too far off from where the market should be, bar the fact that demand has obviously been impacted massively this year. So switching to supply fundamentals, and I'm looking forward to hearing the rest of the panel's opinion on the current fleet size and how this is going to impact tanker markets going forward. But using Vortexa's data, we can observe utilization going back a couple of years. And what's really fascinating was witnessing that for the first time in our records, specifically towards the end of April to the start of May 2020, the amount of laden tankers on the water exceeded that of ballast tankers for the first time. So that's roughly 5.8, 5.9 thousand tankers versus 5.7, 5.6. So the point I'm trying to make here is that it's no secret the tanker market has been oversupplied compared to the amount of cargoes available since the start of this decade. And that's a point that needs bearing in mind. Going back to today, we're in a vicious circle where tankers employed in offshore storage have continued to drip feed into an already depressed market, so increasing the available supply and weighing on those fundamentals. And that, for me, is the biggest challenge of today, to answer your question, Luke. The fact that the world is continuing to draw upon oil stocks, both offshore and onshore, built during the pandemic, that started nearly a year ago, instead of employing tankers for the transport of these same amounts along long haul, or actually medium and short haul trades for that matter. If you combine that with producing countries cutting back on output to support the oil price, it's a triple whammy for tanker markets. And I believe that's going to remain the case until at least Q2, in my opinion. So just to end on sort of demand fundamentals, well, we've got OPEC heading into a meeting on March the 4th, where we've got Saudi Arabia clearly wanting to keep the output a bit steady, whilst Russia wants to proceed with an increase. As a reminder, we're still about 7 million barrels short from where we stood last year. So that's 7% of global supply still being withheld. Now, it was a sacrifice for some. We can think of countries that have suffered, such as Nigeria, for example. But oil prices are now above $60 a barrel. So if that was the aim, and it was, it's worked. Let's not forget the Suezmax in the room. So pun intended for Mikkel here. The 1 million barrels a day of voluntary cuts from Saudi Arabia as well to help clear that inventory. I'm, however, optimistic for the rest of the year. Demand has been recovering quicker than expected, I believe, following increasingly rapid vaccine rollouts. And I'll just leave you with this one stat. OECD stocks are measured closer to their 5-year averages recently. So indicating that more buyers might turn to purchasing cargoes on the spot market as consumption increases again.
Thank you, Arthur. Just a quick note, there's a question come through on slides. No, this is purely conversational discussion. I think it's S. McNeil. This is recorded. We will share it afterwards, and we can follow up with pieces as you require. But thank you, Arthur. Mikkel, I want to bring you in there after sort of touched on the whole element of oversupply and what's happening in tankers. But could you give us an introduction to yourself and TK, and also how you're seeing it evolve your side, please?
Yeah, thank you, Luke, and thanks for the opportunity. Yeah, as mentioned, my name is Mikkel Seidelin. I've been working for TK for about 18 years, coming up on 18 years end of this year, in various different commercial roles in London, Vancouver, Houston, and primarily Singapore. Now based out of London, heading up our Suezmax franchise commercially. From our side, in terms of the markets now, in terms of what we're looking at as sort of the things that's going to determine the market going forward. I think Arthur, he did a good job highlighting a lot of them, but it's really the inventories, I think, which OPEC is going to try and run down, and until until we start seeing that running into the open feeling they have a control of that, or then we might start seeing them pumping more, and of course it's going to increase demand for tankers. That's really the one everyone is watching at the moment. The floating storage has come down, which suggests again the inventories are coming down as well. How fast it will happen? Yeah, definitely Q2, maybe later, but it's going to be and then of course it's going to be linked into to the easing of the lockdowns. It's going to be and when that's going to happen, I'm not really going to speculate on. I'm not a doctor. But yes, I mean, and also when that happens, then how are we going to come back? Because we see, for example, now some refinery utilizations are back to normal in the East, but at the same time in Europe, in the US, and so on, it hasn't really happened yet. We're still in, I think, in the low 80s in the US and probably lower in parts of Europe. How much capacity is really going to come back on the way it was before, and what is that going to do to ton miles and to the efficient trading of the tankers? That thing is going to be more and more interesting to follow. Will the usual trade patterns, are they still going to be in place when sort of things normalize and people have more of a long-term horizon they can actually plan according to, and what will that do to the ton miles as mentioned before?
Sure. So Mikkel, sorry to jump in. Do you envisage then that low demand growth, or maybe higher, but with steady supply growth, is going to lead to sustained oversupply of tanker shipping for maybe the next 5 years?
Well, I think we need to see before. I mean, we have seen some more supply sort of being ordered over the last 4 or 5 months. For various different reasons, not necessarily because of the earnings potential has been there. It's more been a combination of cost of capital and yard cost and yard space. For something more fundamental to come back, we need to see a fundamental recovery in the market. I mean, if you think about the last 2 spikes we've really seen in the market has been because of geopolitics. First, we had Costco sanctions that was caused a spike end of 19, and last year we had the price war, and so you need to see some more, I think, a long-term spike around the fundamental supply-demand side of it before we really see in a bigger way the way we've seen, these 10, 20 ship orders over the yards in terms of growing the supply side of it. We need to see the fundamental, the demand has to be back, and a sustained higher earnings potential than what we've seen in the last, arguably, as Arthur said, 10 years.
So do you think investor confidence is returning now, or do you envisage it returning?
I think it will.
H1?
I think we'll need to see the fundamentals to return, and not industry not relying on these geopolitical events before people really go back and return and invest in a big way. That would be my view.
No, thank you, Mikkel. Very good. Peter Sand, Chief Shipping Analyst at BIMCO. Welcome, Peter. I want to bring your perspective onto the global markets conversation as well, and also maybe in a broader context of climate emissions and net zero. Peter, welcome.
Thanks, Luke. It's great to be with such a great pack this afternoon, and thank you all for spending time during your IP week in our good company. As Luke quite rightly pointed out in his opening statement, BIMCO is the world's largest direct entry shipping association, and from an analytical perspective, we cover tankers, crude oil, and oil products in depth, as well as dry bulk and container shipping. So we try to cover a lot of ground with our really lean team here, but focusing on the essentials. And that is basically what I will try to do today also in this short opening, as I will focus on, basically the US blizzard, the cold spell in Europe, and also shedding a bit more light on what lies ahead of us later in 2020 on the markets as we see it. Because what we should cross our fingers for in 2021 is adverse weather conditions and chaotic geopolitics. Because from a fundamental perspective, we are in deep we are simply so far away from a fundamental balance that would bring around much higher freight rates than what we see right now. But if we focus on the blizzard in the U.S. Gulf Coast states, that often brings around positive impacts on the tanker shipping market, regardless of the fact that of course those cargoes do arrive with some kind of a delay. But when panic and reality hits the fan, basically you want to secure your cargoes. You want to secure that supply is stable, and when doing that, MR tankers trading in North Atlantic have been a bit more busy in the past week or so, trading from well, basically gasoline and other products from Northern Europe, but also we have seen the likes of Aframaxes benefiting not only in Caribbean but also in the Med, but also from the cold spell and the icy conditions that we see in Baltic. So cross your fingers that those well, that you basically bring in time and into place your ship for the next cargo, because that is where you're going to find profitable freight rates when we look into 2021, because it is dire straits out there, and what the market needs to focus on is the long distances, because volumes, I think it's fair to say that that volumes will not recover by any meaningful extent on the global market. Of course, if we look at China and India in particular, we see demand growing there already, but still we are not in a position where the full market is recovered in terms of volumes, in terms of distances, in terms of ton-mile demand before we reach somewhere in 2022. Fingers crossed, and vaccines up and running as fast as possible. So those are the things that we focus on, and in particular also both Arthur and Mikkel touched upon OPEC Plus and who's actually producing what, because that is of course essential when looking at the global oil tanker market. And fortunately, the silver lining of the OPEC Plus alliance, and especially the way that they are managing their production costs right now, where Saudi Arabia is digging deeper in the cost, in the cuts, and where we see Russia being allowed to produce more, that is a silver lining to at least the crude oil tanker business, because what we have seen last year was not only 100% growth in ton-mile demand when we look at crude oil exports or tanker exports out of Black Sea going to China, but we're also going to see that extent already in 2021. What we have in terms of indications already for 2021 is that those trades are still one that is growing, but of course, even though they are growing by 100% on last year, they remain in third place to the key trades out of Russia going to South Korea in particular, but also US. And speaking of US, of course, the most critical newly developing trade from the US Gulf region is of course crude oil heading all the way to Far East, because that is as far as it gets if you transport oil around the globe. So that is surely what we're going to look out for also when coming further ahead into 2021. And I know, Luke, that you alluded to in your opening statement a little bit of going to net zero and also about tanker emissions, but I think for now I will close those remarks, but keep those comments for the further outlook, because I think that lies further ahead, and during perhaps the third part of this talk, we can get back to that. Thank you,
Peter. No, a great overview. I've got one question, but we've had one come actually from Ahmed Burri. I hope I pronounced that right, Ahmed. And the question is, Peter, do you see, and I appreciate you spoke to this a little bit already, is an optimistic outlook for oil and gas prices and supply, considering the pandemic consecutive waves in 2021? And that's our first official pandemic-related question of the day.
Well, in in many ways, you would expect cheap oil to be a boon to tanker shipping because people would buy more ASAP, and I guess that was what we saw also in March, April 2020 when the OPEC Plus alliance broke down initially and where refiners scrambled for cargoes on a global scale. But what we see right now in terms of pricing, it's not really the key driver for tanker demand because the oil price is merely reflecting how well we are doing in terms of rolling out vaccines and how well the overall global economy is doing. So the higher the oil price, the better at least the anticipated market recovery is going on. Because I think it's fair to say that if you go back to November, you saw that early rise in oil prices when the first press releases surfaced that vaccines were on their way. Without doubt, it had no impact on tanker shipping at that point in time. That was just the announcement that things would change very fast. So I can only recommend you to keep a steady eye on the fundamentals and the movers and shakers that are real, in the sense that the oil price may tend to react to things that are not real yet, but will be more real perhaps 6 months from now.
Brilliant, thank you, Peter. We've got a couple more questions coming through, but I'm going to bring these back in later in the piece. So I want to jump into that impact of new technologies. Now, there was a brilliant report I recommend to all of you by McKinsey end of last year, which referenced that data will decide success in the next normal of bulk and tanker shipping. And I think when we look at the bulk and tanker shipping industry, it's historically been characterized by maybe more instinctive decision-making based on judgment, experience, and there's been a gap there in terms of what we can learn and glean with better analytics and insight. So, Arthur, with your Vortexa analytics and insights cap on, could you give us an idea of what you guys are doing in terms of providing some of these analytics and what sort of tech stacks you're working with and sort of some of the benefits and deliverables of each?
No, absolutely, Luke. So I'm going to add another question for myself onto that, is how does the volatility in the market play into Vortexa's strengths? And then we'll look at the strengths that we have. So the more the market is volatile, the more reason exists why that may be, and the more actionable information is needed to understand what's going on. So the first thing is making sure that one really has all the necessary data to make an informed decision, and then identifying and seizing the opportunities available inherent to any volatility, especially in markets like we've seen in the past year with that sort of record volatility. Looking at a screen and seeing the price of oil move up and down isn't enough. You need to understand how much oil is on the water, but then even then go one step further. How much of that oil is in transit? How much is in floating storage? What types of grade make up that oil? Where is it headed? So where is demand coming from? And Vortexa can really help providing you as complete a picture as possible, and more importantly, what that picture will look like tomorrow compared with yesterday. So what do we do? At the end of the day, we provide information, and we do so within a market that's opaque. And more than that, it's incredibly complex. Even if the majority of the data needed to understand what's going on were to be available, it still wouldn't be easy to necessarily understand everything that's going on. So we go one step further and we process that information. So we not only mine the rough diamonds of data, but also cut and polish them. And we do so by obtaining an incredible volume from thousands of sources. And we apply to it our technology, so our artificial intelligence technology, as well as our market intelligence from industry experts. So our users can make these informed decisions. And we do so by using either analytic screens, where the data is presented not only in a visually clear and attractive way, but also in a concise way that summarizes the key trends and links back to how that data came about. Or our users can access the data directly through the API, so what we call the application programming interface, and allow it to flow directly into their own work processes. And here I just want to take a step back and say that it's great to have data, but you need to know what to do with it. And this is why, without going too deep, roles are really changing in the industry. We're seeing a lot more PhDs being hired by ship owners, by charterers, people who have computer science degrees, to be able to really harness the power of that data. One example, one case study I can give you is that as part of our freight analytics offering, we've basically got your lagging indicators. So they allow you to figure out whether a shift has actually occurred in the market. And we've got your forward-looking indicators. So they point to trends that can help predict future market dynamics, whether that's on the supply or the demand side. And in turn, that allows our users to form an opinion on future freight rates, at least in that direction. And one example of a screen that does this beautifully by combining both types of indicators is our upcoming vessel availability screen. So as the name suggests, we present availability of vessels, either for specific laycan chosen by the user or up to 35 days, with the ability to split that between 5-day laycans, depending on the natural fixing window of the tanker class you're looking at. So that's your forward-looking indicator. It basically tells you how many ships are going to be able to pick up a cargo within a specific laycan. And the position list that follows is independent and data-driven. And then our users can filter by owner, last cargo carried, etc. But the real strength of this screen, in my opinion, is the fact that we've managed to combine that with historical availability. So that means that we calculate for every single day where those vessels were, and based on that could have been. And we're talking about a tremendous amount of computing effort required here, because it's only one side of the story to be able to say how many ships are going to be there tomorrow. But if you provide the context versus how many ships would have been there tomorrow yesterday, and a week before, going back as long as a year if you wish, and then you add freight rates on top of that, then you can really start to get a handle of what's going on in the market on the supply side and the direction of those rates. And you can really time your chartering to maximize your earnings or your chartering cost, whether you're an owner or trader. I actually had an insightful chat with a ship owner recently where we compared freight analytics adoption and their use within tanker markets versus dry bulk markets. Now, at the risk of oversimplifying the dry bulk market, we came to the consensus that tanker markets were a lot more dynamic and volatile, and they had a lot more moving parts. So analytics was sort of a welcome edge needed. But in dry bulk, sort of as a paradox, people are becoming a lot more sophisticated, especially ship owners. So we actually arrive at this exercise, which becomes more an exercise of game theory rather than absolute omniscience, as everyone sort of knows what everyone knows.
Thank you, Peter. Sorry, I was excitedly noting down game theory there. But I want to flip it for you. You made a really salient point. There's lots of PhDs being employed into the industry. But Mikkel, if I speak to you, I think we can there's a consensus really that this data, a key part is driving efficiencies. Okay. Now, from your perspective, let's talk to the why as much as the what. So what are they driving? What does it mean for you? Why is it important? And then what's the actual financial impact and opportunities that you see via enhanced analytics?
Thanks, Luke. I think first of all, I think you covered a lot of the basis on the benefits of it for the market and a lot of the things we're looking at as well. For us, a lot of it is to try to use the historic data to forecast how many ship turnarounds, how can we deliver a more safe itinerary to our customers, foresee if we see to try to project where we're going to have our ships open going forward in terms of and improve our triangulation, which again will improve the service to our customers at the end of the day and providing a more competitive freight solution to our customers. At the same time as well, and the more digitalization we have and the different platforms that we have, we can provide the same service and to the customers at a more efficient, faster space. Also in the terms of the market information that Arthur was talking about, yes, there's more data available to all the organizations, and it is revolutionizing, I think, how owners, especially ship owners, and also tanker charters for that matter, are working. But it gives more data on the table, and if you have more data on the table in your market discussions or in your operational discussions, you elevate the conversation to a much higher level much faster. and that means the things you can measure is easily addressed, and you come up with much better answers and results much faster. There's of course there's a balance act to this whole thing. It can't be too much. You got to be careful of not falling into this trap of trusting what's in the black box, so to speak, in terms of, you put a bunch of data, and I think in today's day and age, every player in this market has a bunch of data of their own, and it's easily accessible. Also externally, AIS data is readily available for anybody who wants to pay a fee. It's what you do with that data, and I definitely would encourage the players to use someone like Vortexa and other companies to help them analyze the data, because it's a daunting task, and there's a lot of idle data out there that's not being used probably to optimize the business, whether it's a market call or whether it's optimizing your value chain as a ship owner. But at the same time, be part of the process. Don't give all the data away and get back one number because it's been put through this black box and you don't understand what that number really means or what's been put into it. So there's there's a balance act somewhere, and just because you can use all this data to make better decisions, the experience of your teams, your commercial teams, technical teams, or whatever, it still has a place in this world. You can't measure everything through satellite data. So it's the real challenge, I think, for the players in this market is to get the data to speak to a higher level, and at the same time also train your organization to trust the data and the analytics coming out of it. Implementation is easily half the battle as well.
100%. Mikkel, you mentioned historic data, as did Arthur. A real challenge, and this is me asking the first pandemic-related question of the day personally, but we're seeing so much happening in the last 12 months. How much historic data do you need to make intelligent decisions? And how much now is judgment as we look at all the factors we've spoken to already? What's the balance between how much data do we need to make the smart decisions that we want to do?
I would be hesitant to put a number on it, but
we love numbers, Mikkel. Go on, have a go.
Oh, we all do, but I think that's a very good example of when you still need to run the numbers, you need to run your model, you need to look at the fundamentals, but then you also need to have common sense and business experience in the industry, and put that layer on top of it, of the numbers, because as you said, last year was a massive outlier, and it doesn't mean we should completely discard it, because it's maybe a scenario you can use as a scenario planner going forward. But at the same time, you can't just so you can't discard it completely, but at the same time you can't trust it completely either, and that's where the business knowledge still has a massive role to play. But at the same time, also now you have all this data. 10 years ago, 15 years ago, you didn't, and so to ignore all of this would also be going too far the other way. So it is this balance act of getting the gray hairs to really talk to the PhDs in Arthur's words, and get that to, and if you can merge those two things together, then you end up with something really powerful. But I think you have to remember, especially on the tanker side, it's a relatively small data set we're working with. The average VLCC Suezmax owners tankers being fixed 6 to 10 times a year. In order for these AIs and those things to work efficiently, you need a massive data set, and you need to be able to, and you also need to have a few operational variables. And for the tanker market, that's almost the exact opposite. But again, you would still have benefit in terms of looking at it. It would still be just to look at it, but at the same time, put it into the context. And also, if you don't understand the numbers in the context of the business, you will analyze the numbers in the wrong way, and we've seen many examples of this. We definitely welcome all the numbers coming in, the AIS and so on. I think it can be used for so many different ways, and it's a great tool. But there's still some old school tricks that we can still use going forward.
No, very good. Arthur, any comments on that?
I absolutely agree with Mikkel when it comes to it being a balancing act, and I think also it depends on. Well, it depends who we're looking at within the chain in the market. When I said that we're seeing the democratization of advanced analytics and artificial intelligence and the data that comes with it, most importantly is the ability to combine those two worlds. This isn't a new world appearing, it's just more tools becoming available to those that really understand that market, and that experience, can't be discarded. I think also what drives it, and Mikkel, feel free to correct me, but we have a drive towards making more money at the end of the day, but it's really the bottom line which has driven sort of new technologies towards users in the freight markets. I'm not going to speak to all of them, but whether we look at Internet of Things, AML, digitalization, it's about driving those efficiencies and those cost-saving opportunities of already existing operations, because that's really what an owner has the most control of. When we look as well how earnings can be extremely volatile due to these black swan events that we've seen in the past 2 years.
Thank you, Arthur. Peter, I can see your hand is raised.
Sorry, sorry, Peter. Go ahead.
Thanks. I'll bring Mikkel in just quickly to just round off that point, and then bring you back in a moment, if that's okay, Mikkel.
No, it's just more a compliment to Arthur and what they do with Vortexa and other. I mean, one of the things where I think we're getting more traction on digitalization now is actually thanks to companies like Vortexa and other software companies and digitalization and research companies that are becoming better at understanding the business and then using their data analytics skills to transform it into the business, because that means they penetrate and the solutions are much more easier to apply in the industry versus we've been talking in certain companies. There've been talks about using this data for 10, 15 years as well, but it hasn't. It's only the recent years where we've really seen it being applied, and I think that's thanks to service providers that actually been doing a much better job understanding the business and coming up with more realistic solutions than maybe before. That was it.
Thank you, Mikkel. Peter, welcome back.
Yeah, I think standing on the shoulder of giants now, what we really need to acknowledge here is that whatever analytic tool that we're looking at, it will remain an assistant to the decision maker. It will not make the decisions by an algorithm. That is important to underline here, because obviously we have now seen a decade or something like that, or at least 5 years, where a tsunami of various IE solutions or AIS-based solutions have come upon the entire shipping industry, and in particular also the oil tanker business, because that still remains the most complicated of them all. But being the most complicated of them all, obviously, it also requires brilliant minds to untangle the information that those more or less smart solutions can bring to the decision table. Because without the old school and the ability of the old school also to make use of the new school, we are completely lost. We're of course constantly somewhat working in a vacuum of information where we would like to know exactly what happens now and preferably also tomorrow. But when we have data available, they are only solid going back to 2018 to 2019. Something like that. So having to work in such a vacuum of information is really, really tricky, and that's really when old school is the cool interface that you absolutely make sure that is a part of your decision making. And it's not because I have gray hair, but that's just what I trust is the right way to go forward. Cheers.
Thank you, Peter. And actually, while you're there, I'm keen. I think a couple of key pillars from Arthur and Mikkel was around application and trust. We're seeing increasing talk to cyber and attacks now. I don't know if BIMCO would have a perspective. Obviously, there was a IMO as sort of a fairly large-scale hack end of last year. Are you seeing that increasing across shipping as a whole? Do you have any advice or thoughts on that area and how that intersects with trusting and actually applying that data?
Yeah, surely BIMCO is working with industry partners also in setting standards for cyber security also at sea. Fingers crossed, most cyber attacks have taken place with at least land-borne organizations also involved container shipping predominantly. And of course, we have also seen various tests and trials where hackers have entered various programs and deliberately try to make a scam and make a case for more cybersecurity into shipping. But so far it remains a fortunate fact that when you are in high seas, you are also out of reach to a large degree in terms of being off the grid. You are of course in satellite contact, but it's not like we are running a fully automated fleet on a global scale anytime soon. We are still a significant distance from where we are today and to a fully autonomous fleet that would potentially be running on a global World Wide Web. So obviously what we see is early steps on board ships to take utmost care of the threats that cyber indeed also presents to our industry, and it's low-hanging fruits. In many cases, it's what we are not allowed to do in the office. You basically implement on board the sea, but wonderfully many of the guys and the seafarers out there have not been in an office for many years. So they of course live in somewhat a different world to those of us that are chained to the World Wide Web.
No, interesting.
Much work is done, indeed.
Yeah, thank you very much. There's been a question come through, which actually is from Mikkel Papakostas, which was actually the next question on my list anyway. And I'll bring it off, for instance. We want to talk to actually some of the examples and whatnot. Mikkel is asking, could you provide some examples of the data on freight markets? Are you talking congestion, ships available, or others? So, Arthur, I don't know if you could talk to some of the examples and maybe some of the cases you've worked to and give it a light there.
Yeah, I mean, right now, the possibilities are limitless, in my opinion. You can look at the supply side of the equation. So by looking upon vessel availability that we already talked about earlier, you can talk on the demand side as well by measuring ton miles and utilization, for example. So that allows you to look at a benchmark for your own utilization or for maybe changes in trades in the market. Are more cargoes coming out of a certain region as opposed to another? What else do we have? Speed as well can be a great indicator in some cases of what's going on. That's something that we're able to measure using our data. With speed comes distance, as that is also a component of the ton miles equation. Port congestion, absolutely. You can look at how many ships are waiting into a specific anchorage area. You can also calculate historically what the average loading and discharge time is within that particular area. So that allows you to see whether the situation is genuinely an outlier or not. No, once more, to repeat, the possibilities are really limitless. I think, it's limited by the imagination of those working on it. But also it's about serving a need. It's about serving a need in the market. And most of the time I find that some of the products we work on come from the market, come from our clients. And we try to be responsive in that sense, in that sort of feedback loop, because at the end of the day, you want to meet their needs. You want to be able to help their operations. And like Mikkel said, they're the ones who are going to know best what they need. And we need to make sure our data sort of fits seamlessly into their workflow.
Thank you, Arthur. There's a lot of questions coming through which are all touching on the final theme, which is good. So thank you for your engagement and for putting those forward. But the final theme really is framing this in an overall context for world energy demand. There's also a huge climate piece we've spoken to already. I think the IMO are looking at 40% reduction in carbon intensity of emissions by 2030, and then a 70% reduction compared with 2008 levels by 2050. And this is a narrative that is going to gather pace and just snowball. So to the group, and I'll let you raise hands to go first. Starting open, what do you see as the commodity of the future, and what might be the energy commodity of the future that will be transported by 2030 and 2050? Who fancies going first? When I ask an open question, I always find myself
I'm extremely pleased to try my luck in this one, because obviously everybody wants to know what goes on tomorrow, and we may have a slight clue on that. But what will happen in 2030? I think we need to really put our heads around that. But in absolute terms, I think the Biden administration and their re-entry into the Paris Accord is at least one turning point in the support of the Paris Accord. With the Trump administration around, not much could be expected in terms of cutting global emissions. Whether the Biden administration will succeed in that, I'm not really sure. But what rests for sure is that this is a very, very long and very, very tough and tall task. We know the Chinese have set their first threshold in 2060. So at least 40 years from now, half of us in this crowd, I guess, will be in the old guys' room and not speaking about the markets anymore. But just looking ahead into the tanker business and the oil demand going forward, because as alluded to also in my opening, it's a little bit of a game of two horses here, where we have China and India basically still growing their imports of oil, and where we have the entire Western world, OECD and Japan, not focusing on not growing their imports anymore. Actually, they're doing the opposite. So we are entering a decade where trade lanes will change. We are also to expect still growing oil demand going forward, at least if we go by what the International Energy Agency called the stated policies scenario, basically what politicians have said they will do. In that scenario, we still have growing global oil demand. So rest assured that politicians need to change course should we face the demise of oil, or at least a global decline in oil demand. So comfort in the stomachs on those measurements. But as also alluded to right now, this pandemic may bring around lower emissions right now, but it may also bring around tougher geopolitics and negotiations going forward, because what a crisis always do is that it makes politicians look more inside than outside. And what we basically need in terms of cutting carbons on a global scale is that the world leaders need to work together on how to reach that, if that is really a goal that they are setting for themselves. But what does it mean for tanker shipping? I think in all fairness, tanker shipping have grown extremely steady over the past decade. Going forward, demand is likely to come down, but at least in the stated policies scenario, and also when we rely on the brilliant minds of IEA in that regard, it still seems as if the world is not really decarbonizing, at least on fuel. And if we go by the tanker industry or the shipping industry itself, the task may be even taller, because it is easier to put the power grid up and put windmills to support of the land-borne energy drive towards more power than it is to fill a VLCC with batteries or a windmill in order to decarbonize the world. But I think it's fair to say, and BIMCO is fully supportive of the work done at IMO. I think it's fair also to defend the work done at IMO right now, because currently it seems as if the shipping industry is the only one with a fixed target in terms of cutting carbon, despite the fact that we are getting quite a lot of smoke for not doing anything. I think if you look into the finer details of what is actually being done at the IMO, we're on the right track here, and that may not have been read aloud in mainstream media as we lack skills in public media, but I think it's fair to say that the trajectory of shipping emissions is way lower than what we have seen from the rest of the world since the Paris Accord was signed some 6 years ago.
Thank you, Peter. Mikkel, I've had a question related but directed to you, which is what is the level of support or interest from TK to trial fuel-free, zero emissions, zero fuel cost technologies and systems, if at all?
That's a very direct question. No, I mean, I think we will be open to explore new avenues as we're going into this, and we have these regulations coming up. So yeah, we are exploring different avenues. I think every prudent owner should, because if you don't really know, we know what we're trying to solve for, but we don't know how we're going to get there. And so to lock yourself in on any one solution right now would be extremely risky. And so and at the moment now, you're still seeing everyone is gearing up, trying to measure where they want to position themselves and how much, tracking emission numbers and so on. And it's still, in that respect, it's still very much in its infancy. So yeah, I mean, we will be open there to discuss with anyone about like what solutions might be out there, because are we willing to commit at this point? Maybe not, because where's I mean, the immediate reward of that and the risk of getting it wrong might do more damage than good. But no, I mean, it's on everyone's radar that we have to keep an eye on whatever's out there and how you can solve for these things. And also because one of the challenges is not so much, everyone is looking at the demands of 2030 from IMO, the demands of 2050, and it's fine to come up with future solutions that might work by then. But we also have to make it there. We also have to deliver energy to the world, where the energy demand is growing. And of course, renewables and other sources of energy is going to fulfill that need, which is great. But if we want to have a higher quality of life across the world, the energy has to come from, at least in the transition phase, has to come from many different places.
No, I think it's a really, really good answer. And sort of touching on parts of that, between financial restraints, Seidelin principles, and there's an uncertainty on future propulsion technology. Do you see a risk of underinvestment in the tanker moving forward, Mikkel?
Well, it's a trick question, right? I mean, underinvestment, as long as you have tankers on the water, that's not a bad thing necessarily for that owner. But no, that could easily be, because as I said before, you want to hold your options open as a tanker owner. And once you order a new tanker that you hope is going to be future-proof for at least the 20 years of its life, you kind of put your chips down. And in this environment, it's if you invest in the wrong direction, so to speak, you're risking a lot.
Mm-hmm.
And I think it's great, as Peter was saying, the IMO's ambition level and trying to support this environmental move, I think is great. But again, the lack of actual this is the solution to it means that a lot of people are going to sit on the fence for as long as they can, and that could lead to the underinvestment in the space for sure.
Understood. And we had a question come through earlier in the piece, which I want us to come back to now. It was from an anonymous attendee, so I can't say who, but the question I thought was quite good, and I put this to Arthur first, which is the IEA, or the International Energy Agency, trimmed 2021 global oil demand, and the oil will peak by 2030. How does that impact the shipping freight market and industry? Arthur, is that something you can speak to?
Absolutely. And in a sense, that's related to decarbonization of the industry, to the future sort of cargo of the future. And I'm going to use that to build a bridge towards what was said by Peter and Mikkel. Mm-hmm. Some great points, by the way. I do believe as well the shipping industry has come under the spotlight a lot. Maybe all the haters should just stop eating meat and leave us alone. That's going to be my controversial comment of the day. But it's no secret that the decarbonization of the industry has definitely been accelerated. So what we did as Vortexa is we averaged a lot of forecasts for oil demand going forward. Maybe some we should have ignored, but we're really trying to get the most comprehensive picture. And And we found that in 2030, oil demand levels will be at 85% of those of 2019. So that argues that, you know, we've already breached peak oil and we're heading towards it during that time. And that it falls off a cliff after 2040, so at 50%, and then 25% in the 2050s. And that's why I think the market of seaborne energy cargoes is going to be a lot different. It's going to look a lot different. And that's perfectly fine. It doesn't mean it's death, but it's transition into something else. Peter mentioned long distances earlier during the webinar as the sort of savior for the market. I think with the increased use of renewables, energy production will be a lot more localized. But what's important to understand is, I think the problem is nowadays is people are a lot better at explaining things than understanding them. And, you know, when they say we need to stop using oil, it's about that incremental share of those incremental energy needs that we're going to need. So I don't believe oil is going anywhere in the short term. You know, if we need more energy, then it's probably better that it comes from other sources, more carbon emission friendly sources. But that doesn't mean it's going anywhere. If we take hydrogen, so the first hydrogen tanker is expected to complete its first voyage at some point this year. And the reason why shipping is here today is because of economies of scale at the end of the day. And I find it incredible that we can transport 2 million barrels of oil on a ship and the amount of energy that can generate. But it simply isn't the same with 75 tons of hydrogen. And that's where we stand today. So we'll probably have a lot more hydrogen tankers, you know, as oil demand will lessen probably in the next few decades. We'll have a lot more different tankers. But it's not going to disappear because the mythical peak oil has been reached or not. And I don't want to overextend here, but also just touching on what Mikkel said regarding underinvestment. It's absolutely a risk. I think ship owners or banks or financing institutions, they're reluctant to commit really to a large capital expenditure, especially in these times. Last time that happened was with IMO 2020 and scrubbers. I think returns are split across the industry, and investing in a tanker is a long-term commitment. We're talking about the length of time it builds it, which is already long for a lot of people, but then you've got its trading life. So, you know, if we're unable to see more than 2 years ahead, and if black swan events are becoming the norm, it's hard to put money in this industry. Now, whether Mikkel mentioned the one solution, it'll probably be a mix of solutions, and we'll probably be looking at a more eclectic mix than the fact that today we only have bunkers to simplify, because we already have LNG tankers, for example, you know, on the seas, but it'll probably be a mix of solutions.
Very good. I'm going to put one quick question to you after I've just seen come through, which I think is quite good, then invite Mikkel and Peter just for some closing remarks on everything in a second, so I realise we're close to time. So quickly after, from Payman Eslami, tackling marketing forecasting using AI model data-driven approach. One of the challenges is unavailability of, and I think it means crisis data. Can you speak quickly to how Vortexa can overcome that challenge?
What do you mean exactly by crisis data?
I'm not sure, frankly. Payman, if you want to comment quickly, we can, or if not, we may have to come back separately to that question again. So I realise we're pretty much close to time. So I'm going to go to Mikkel first, and then Peter, and then Arthur. In 30 seconds or less, if you could give me a quick sort of recap of your thoughts, the challenges, and what you see happening through 2021 for shipping. Mikkel first.
Coming successfully out of changing gears once again for the third time almost in 12 months, going to be difficult. Hopefully the market will change again. Getting back into the office, hang out with your colleagues every day is going to be great, and hopefully. But I think, yeah, the keeping on top of the changes that we ultimately will see as things go back to normal, what will go back and what will not, and what will be changed forever. And those things are going to be really interesting to watch and follow.
Thank you, Mikkel. Peter?
I think we had had a lot of great questions also in the Q&A. I've been fortunate to give replies directly to some of them, while the rest of the panel have been busy talking to you, Luke. But the one thing that I think we need to pay attention to also going forward is how China Inc. will basically react to its increasing need also for oil, because what we have seen in a dry bulk industry, for instance, is that more cargoes carried into to China has been made on long-term deals with Chinese owners. So how the market for the individual or independent owner, tanker owner, will play out will absolutely be critical. And on top of that, of course, sanctions will always be fun to watch out for. And I think when fingers crossed, politicians should get their act together and make sure that we will soon be able to meet in person, not only in here. In between now and then, a lot of the spectacle hopefully will bring around the odd spikes also to tanker freight rates, which will, without those, be a tough 2020. Thanks for having me today, and thanks for your kind attention.
Thank you, Peter. Arthur, in 30 seconds or less, how do you see?
Cheers, Luke. Yeah, I'm going to keep it short. I've had a great time today with Mikkel and Peter. I think we've touched on some really interesting things. I'm going to use a cliche saying to end this, but how the Chinese character for risk and opportunity is the same. And I think that's what we have this year. We have the opportunity to make some changes with decarbonization accelerating, but also with simply using technology and analytics to become fully ingrained in the workflow. And I think that's what we'll be seeing. And I'm very optimistic for the rest of the year for freight markets.
Thank you, Arthur. I can see Payman's commented just quickly that in terms of crisis data, we're looking at really resilience. But I think what we will do, we are out of time here. We've got a lot of questions that we've answered, some of, not all. This meeting has been recorded, so if you're watching it later but not live, hello and also goodbye. This will be stored on our Reuters Commodities site, so you can access it there. Also, if you want to access or put questions to Peter, Mikkel or Arthur, please come to me and we will connect you if they're keen to talk to you further. Okay, so that's it from me. A very big thank you to the panel. You've been fantastic, lots of insight, and it sets us up nicely for the rest of IP week. It's just gone 4 o'clock and the pubs are still closed. So on that note, folks, have a great day and we'll speak very soon. Cheers.
Good to be here.
Cheers,
Take
everyone.
care, everyone.
Cool.
Bye for now.